Welcome to the Deep Dive. We're the place, where we go beyond the headlines. We dig into those earnings calls, the ones that really move the needle. And today, we're tackling the Q3 2025 call for Newell Brands. It dropped pre-market, Halloween, actually.
Yeah, and it felt like it for shareholders. Definitely more trick than treat.
Exactly.
It really was a shockwave. I mean, we knew going into that call, what was it, 7:30 a.m. Eastern?
Yeah, early one.
Right. We knew the backdrop was rough. You had macro volatility, trade issues flaring up, consumers, well, pushing back on prices. But the size of the miss, and especially that guidance cut, nobody saw that coming. The market reaction was just instant. Extreme caution, bam.
Unforgiving is the word. Okay, so our job today is to figure out why the stock just cratered. We need to unpack those numbers, the misses.
Like, look at management's story, right? This whole tariff shock idea.
Exactly, and what that guidance reset really means. So let's jump right into the figures that did the damage. So the headline numbers, a clear miss, especially revenue. They clocked in at $1.81 billion.
Right, and the street was looking for $1.89 billion. That's a pretty big gap.
It is.
And that gap, it meant net sales were down 7.2% year over year. Core sales down 7.4%.
Okay, and EPS, normalized EPS was 17 cents. That was only slightly off the $D.18 consensus, wasn't it?
Yeah, slightly. But honestly, the market barely blinked at the EPS miss. It was the top line miss, plus that outlook cut. That combination just triggered a huge repricing. Signals the market thinks, the structural issues are maybe worse than management's letting on, or at least outweighing the internal fixes.
And the financial stress shows up in the cash flow, right?
Oh, absolutely. Look, normalized EBITDA, $225 million. Okay, that's down from $250 million last year, which isn't great. But the real flashing red light, year-to-date operating cash flow, only $103 million.
Wow. Compared to
$346 million this time last year.
Oof. Less than a third.
Exactly. That's not a dip. That's the sound of the engine sputtering under all this external pressure.
Yeah.
Management, they spent a lot of the call explaining that top-line miss. They framed it as a triple threat.
Triple threat. Okay.
Yeah, three sort of distinct macro factors hitting them all at once. Externally focused things.
Okay, let's break those down. What was number one?
First, retailer destocking. The CEO basically admitted they got this forecast wrong. They knew retailers were shifting inventory strategies, moving from DI, direct import, to DD, domestic delivery.
Right, where the company holds more inventory risk with DV.
Precisely. So they expected maybe a 1-point sales headwind from retailers drawing down inventory because of that shift.
Okay, 1 point. And what actually happened?
It blew up into an estimated 3-point headwind in Q3.
3 points. Wow.
Yeah. So retailers held back orders way more than expected, especially late in the quarter, like September. Much more volatile ordering.
Okay, that's a big hit. What was factor number two?
A sudden international slump. This one really hurt because they'd had, 6 straight quarters of international core sales growth?
Right, so that reversed hard.
Violently. 2 key markets, Brazil and Argentina, both top 10 for them, just hit a wall. Brazil ended the quarter down, get this, 25%. Macro issues, tariffs again.
25%. Good grief. And Argentina.
Argentina, retailers basically stopped ordering altogether ahead of their election. Just uncertainty paralysis.
Okay, destocking, international slump. What's the third leg of this stool?
Factor 3, and this one's key for the profit hit and the guidance. Consumer price resistance. Simply put, they raised prices pretty aggressively to cover costs, especially those tariffs.
Makes sense. You'd have to try.
You would. But they got out ahead of their competitors in some key categories. And the result, what they called price scraping.
Price scraping, meaning competitors just undercut them.
Exactly. Saw their higher price on the shelf and just went lower. So Newell Brands lost significant volume because consumers, unsurprisingly, opted for the cheaper alternative right there.
So tariffs, elections, inventory shifts, it sounds like a perfect storm, but is it just macro? Or is it revealing some underlying weakness, like maybe not enough pricing power?
That is the million-dollar question, isn't it? That's what the market's grappling with. Management's narrative leans heavily on the terrible weather argument, especially tariffs. They're now flagging $180 million in incremental cash tariff costs for the full year. That's up from $155 million just 2 months ago.
Another chump.
Yeah. And Q3 specifically, the total P&L hit from tariffs was about $0.11 per share, and that included roughly $24 million just from those one-time 125% China tariffs.
11 cents a share just from tariffs in 1 quarter. That's a major impact.
It's a punch to the gut, yeah. No matter how efficient you are internally.
And looking at the segments, you can see where the pain landed. Home and commercial down almost 10% core sales.
Right, slammed by those kitchen pricing issues we talked about, but also significantly Yankee Candle destocking.
Ah, tied to the brand restage.
Exactly. Retailers cleared out old stuff before taking the new inventory. Suggests maybe the timing between the restage and retailer readiness wasn't quite synced up.
And learning and development.
Similar story there. Down 5.6% core. Management blamed competitors for delaying their price hikes in writing until after back to school.
So New Brand was stuck with higher prices during the key season.
Yep. Lost share, lost volume right when it mattered most.
Any good news?
Well, relatively speaking, outdoor and recreation was almost flat. Core sales down just 0.9%. Management's trying to spin that as turning the corner.
Okay.
Thanks to some simplification efforts and better inventory control there, it's one small area they can point to for internal execution working. Which brings us right to the central tension, right? Management was really trying to sell this story of structural resilience.
Making progress internally.
Exactly. But the market just completely ignored it because of that guidance cut. Let's look at their defense first, though, the structural points.
Okay, the margin argument. They said normalized operating margin was 8.9%. Which is down year over year.
Down 60 basis points, yeah. But their argument essentially is ignore that one-time China tariff shock.
That $24 million hit.
Right. Pull that out. And they argue their internal cost work actually expanded margins by 80 basis points, up to 10.3%.
So the underlying engine is getting more efficient, but the external storm is just too strong right now?
That's the narrative. And they backed it up, pointing to overheads as a percent of sales declining about 120 basis points year over year. First drop in 3 years, driven by restructuring and tech investments.
Okay, that's a real positive sign on cost control.
It is. And they also highlighted A&P spending, advertising, and promotion. It hit its highest rate as a percentage of sales in almost a decade.
So they kept investing in brands even with demand softening.
Right, showing commitment there. But
here comes the bad news again. All those wins just got wiped out by the guidance cut. That's why the stock tanked.
Absolutely. The full year 2025 outlook got slashed. Normalized EPS now expected $0.56 to $0.60.
Ouch. And sales.
Net sales now expected to decline between 4.5% and 5.0% for the year. That is a massive reset from prior expectations.
And Q4 doesn't look much better.
No relief in sight immediately. The Q4 guide is for normalized EPS of just $0.16 to $0.20. And critically, that includes an expected $0.10 per share negative impact just from tariffs.
10 cents again in Q4. So this tariff headwind is definitely not going away quickly.
Not yet, it seems.
And we have to touch on the balance sheet here. Net debt, $4.5 billion. The leverage ratio, 5.3 times.
Yeah, 5.3x net leverage is high. It leaves very little room for error. When sales fall off like this, that debt load means cash flow has to prioritize servicing debt over everything else. Flexibility is just gone.
It really amplifies the impact of any operational miss.
Hugely. That said, management did try to offer some hope for 2026. This is key for anyone thinking longer term. They sounded pretty confident that operating cash flow will significantly improve next year.
Why? What's driving that expected improvement?
A few things. Lower CAF taxes, lower bonus payouts after a tough 2025, and crucially, lower capital spending CapEx as some big IT and supply chain projects finally wrap up.
Okay, so stepping back. The market looked past the internal margin efforts, past the cost cuts.
Right past them.
And focused squarely on the outlook cut. Driven by tariffs, driven by that consumer price resistance, and the fact the broader sector, XLP, was stable, confirms this was really a new brand-specific problem.
Totally idiosyncratic move. So the pressure is really on management now. They have to hit this new lower bar for the full year. They have to show that top line stabilizing in Q4.
What's their immediate plan to do that? What are they pinning their hopes on for Q4?
Okay, a few key things they highlighted. First, they argue those Q3 inventory issues, the DI to DD shift, the destocking, they think that's mostly done behind them.
Hope so.
Second, international, remember, 40% of sales. They expect it to return to growth in Q4.
Based on what?
Banking on Brazil stabilizing somewhat,
Yeah.
and maybe some post-election clarity helping things in Argentina. It's a bet on external factors calming down.
Okay, bit of a prayer there maybe. What else?
Third, they think they can finally start winning back share in categories where they have a tariff advantage, like writing, because they make it domestically.
Because competitors are finally raising their prices.
Exactly. They said they started seeing competitor price increases hit shelves in October. So that should level the playing field, theoretically.
And longer term, they're pushing innovation hard.
Yeah, accelerating it significantly. Planning over 20 Tier 1 and Tier 2 new product launches in 2026. That's up from 15 this year, covering every single segment, trying to innovate their way back to growth.
All right, let's shift gears. This is our segment where we float a not financial advice idea. High risk, potentially high reward. The stock obviously got absolutely crushed, closing around $3.40 after the call.
Utterly hammered. Yeah.
So the whole risk-reward picture now hinges entirely on when, or maybe if, this turnaround story actually plays out.
Right. And look, if you're someone who actually buys management's argument, if you believe those Q3 issues were truly temporal, just a bad confluence of short-term external shocks,
and you believe the underlying margin gains show the core business is sound,
then you could argue the market is fundamentally mispricing this thing right now. Because the current price seems to bake in continued top-line decline, maybe indefinitely.
Okay, so the thesis is basically bet against that market pessimism. Bet on management's timing being right for once.
Yeah.
That the Q4 inflection points are real.
But maybe bypass the immediate Q4 earnings noise because that could still be volatile.
So what's the trade idea? Again, purely hypothetical, not advice.
The trade idea, maybe look at long call options, but go further out, say expiring April 2026.
April 2026. Why so far out?
It gets you past the immediate Q4 volatility. You're betting on the full impact of that big 2026 innovation pipeline hitting the market. You're betting on inventory normalizing, and crucially, on that significant cash flow improvement management expects next year actually materializing.
So the catalyst isn't Q4 results necessarily, but maybe signs of margin expansion plus stable core sales sometime next year against a hopefully stable consumer backdrop?
Exactly. You're targeting a potential return to, say, a mid to high single-digit stock price, capturing that recovery if it happens over the next year or so. It's a bet on timing and execution.
So just to wrap up the core tension here for you, you've got this genuine structural progress internally, overheads down, operating margin looking better, if you exclude those big one-off tariffs.
Real internal improvements.
Yeah, but completely wiped out, just overshadowed by these external shocks. Tariffs, the international macro hits, and let's be honest, an execution fumble on pricing, all leading straight to that guidance cut.
So as a listener, you really need to weigh that balance. How much of Q3 was truly temporary bad luck? How much was maybe a sign of deeper issues like lacking real pricing power?
And how much faith do you put in that 2026 cash flow rebound materializing? That's critical for the debt situation. Right. And here's a final thought for you to chew on. They're spending heavily on A&P. They're launching this huge wave of over 20 innovations next year. The question is, will consumers, especially the lower income and younger ones who are pulling back on general merchandise right now, actually respond? Can compelling innovation at a good value, as they say, win back wallets in this economy?
That's the bet. But always, always remember the risks here. High leverage turnaround stories. They are inherently risky. And just to be absolutely clear, this deep dive, all this information, it's purely for educational purposes. It is definitely not investment advice.